Abhimanyu, it's such a pleasure to meet you once again. So, Abhimanyu, before I get into some specific questions, what you built with Hero FinCorp is truly iconic. So, tell us a little bit about the journey before we dive in further.
Thanks, Neeraj, and always good to have a chat with you. I think the journey has been incredible, and fortunately, I had a good fortune of the Hero brand behind me that I could leverage on in building a very solid financial services business. And we started the business about 2012 in its new avatar of Hero FinCorp. And over the last about 12 odd years, we have emerged as the digital lender of Bharat. And our real purpose is to empower every Indian's dream of upward mobility. We call ourselves a financier from wheels to walls because we started two-wheelers and we go up to walls, which is home loans, but we don't end there. Of course, we go beyond that. So really touch the social fabric of India and acquire more and more Indians, the common man on the street who we can grow with.
I mean, a digital lender of Bharat is truly incredible. And as India's income pyramid starts trading up, driven by both the emerging affluent and the next billion households, and the presence starts going way beyond the metros, I think that is hugely, hugely needed. Are you seeing some specific behavior shifts in those consumers, which are very interesting to, from your own learning, which one can broaden for consumers or listeners in general?
Yeah, so, one of our thesis is that the GDP is expected to nearly double by 2030. And all of this, of course, will have a higher household income, and affluence, which is being spread, is being spread beyond metros. So we will see a lot of behavior change in the next billion out there, and the behavior change that we are seeing in more affluence hotspots today is we are seeing the number of cars that people own is much higher, right? The loans amount of loan that the businesses took for capex is at probably 21% in 2018, which was 17% in 2013. So the SMEs today have the strongest balance sheet, right? So which are under-levered, which means they have the capability to lever more. So what we are seeing now is a real shift to asset creation, to consumption, to aspiration. So both the shifts we are seeing, and these are being fueled, of course, by finance, right? A lot of that is being fueled by finance, and a lot of it is being fueled by formalization rather than just over leverage. So there's no overheating of the market, if I may say so, but it's more of formalization that is happening, which is causing a good shift where the younger population, the new population who have income and who are going to have a higher income over time are starting to own assets, starting to own cars, wanting to own homes, starting to own electric vehicles, and starting to consume a lot more.
Got it. This is super helpful, Abhimanyu, because it gives a real sense of what's happening on the ground. Often there's a debate about, is the India story concentrated to the top few cities, and does it extend beyond that? So what you're telling throws a real light on what's happening at these 180 hotspots and beyond that you're calling out. So I had one more related question. You called yourself a digital lender, and you talked about formalization. So all of that needs to go from a place, what I call data dark to data light in some sense, right? Because your approach, I'm sure, is data first or data led. So is that correct? And if yes, tell us a little more about it.
Yeah, actually, the behavior change, and what I was saying earlier was on a lot of this asset ownership and consumerism is being fueled by finance, is not being fueled by overheating, but by actually formalization, which means we have moved away from the data dark ages to data bright ages. I remember when we started 12 years back and till very recently, till probably 4 or 5 years, for a SME to get a loan against property for either capex or working capital, they used to provide their balance sheet, or we used to have this product where we had to send a CA, a chartered accountant, to go to their shop and figure out what their sales and their margins would be. And imagine now, today we have an API to GST. So GST gives us access to GSTN and gives me data of what GST income tax he has paid and helps us to actually decipher a balance sheet from source. So it's a whole next dimension, because now we have ability to underwrite. Firstly, reduces turnaround time. Secondly, helps us to be more accurate. And thirdly, it is authenticated information, right? It is information that we are getting from source. For another example of that would be from the SME perspective, we have the Udyam portal, which gives us a lot more access, which was never available. From a end customer, uh, there's a new NBFC license which RBI has given called account aggregator. And I remember earlier we used to have PDFs of account statements that used to come into our system. And we used to have CPAs who used to be really writing down and seeing debit, credit, and say, okay, what is the average bank balance? Today, obviously, with consent of the customer, I can get into account aggregator, which gives us APIs to get into their bank accounts and get information directly from their bank account, from their bank, which they give us a consent to. So it gives us authenticated banking behavior of the customer from the bank within seconds. Really is a game changer, right? So this is another game changer which is enabling credit inclusion. So which is actually enabling fast credit, affordable credit. Because earlier we used to have lots of CPAs underwriting this. There should be unauthenticated information. Obviously, there was a price to it, and the customer was paying price. So because of this data bright, not only do we have a whole sort of inclusion where we see a lot more people who were not included in the formal finance coming in, but also affordability becomes lower, right? It becomes higher because we are able to charge them lower because our OPEX is much lower. So we are in a very interesting time in India. And I believe it is the time of data, and data is changing the whole financial services paradigm. These are two small examples, but there are many more. In fact, recently, the Reserve Bank of India, the governor, did a conference in Bangalore, which I was a part of, which was called the Global Data Public Infrastructure Conference, where they had global leaders. And he announced this new product called ULI, which is called the Unified Lending Infrastructure, which will be stronger than UPI. And what ULI does is it creates a flow-based lending product, which is frictionless, and it has the data of, imagine, a farmer's land records, which earlier you had to go to SRO, which gives they have actually integrated with all the farmers' land records on how much land do they own. Not only how much land they own, what is the productivity of their cattle that milk is supplied to Amul, right? So really giving, and it's a shift which is moving not only from private players like us, but the regulator, because they want to democratize credit. They want to actually get into inclusion. So this ULI is the next big trend that we see, which will really help in providing credit to the last mile and getting data, which is authenticated data, and enabling the farmer to get affordable credit, unlike what used to be maybe a few years back.
Thanks for sharing all of this, Abhimanyu. Incredibly exciting about the possibilities that exist building off this. I can tell you one thing, as I travel in my role across Asia and other parts of the world, the amount of desire to learn from what is happening in India on the whole GDPI or DPI, digital public infrastructure, is incredible. I mean, I often gush with pride also when I hear it, because it's something for all of us to feel good about, but most importantly, something which will hopefully benefit consumers in India and across the world in droves, right? I mean, That brings me to a different theme. When every time the market goes through these kind of changes, there's this belief that you touched upon it is not overheated. But there's also this belief, there's always a bit of a trust deficit, right? Is is the underlying data to be trusted? Is there some issue? Is it ultimately building up to a bubble? I just want to ask you, what do you have to say to that? Is there enough? Is the supervision strong on the trust building side? Can NBFCs hold themselves to a high ground on those? Sorry, I'm just being a bit sharp, but good to ask this question.
So I think you're being politically correct by asking a very straight question, but in a very, very gentle way. The NBFCs no more are shadow banks, right? So I think that's one big message we should take with us, right? And this has been showcased when the finance minister has announced the budget. She used the word NBFC multiple times in the last few budgets. This has been showcased when the governor has announced. So the mindset has changed. And that obviously is done by the amount of supervision. We have gone through a very different regime now. NBFCs now have transformed, RBI has transformed supervision for NBFCs. And they've come out with this new regime, I think, which went live October last year, called scale-based regulation, right? And as per scale, they have a pyramid with different tiers, NBFCs, the top layer, upper layer, middle layer, base layer. And as per the layer, the supervision intensity and regulation intensity increases. You might know this. Some of the NBFCs who are in the upper layer are bigger than private banks in India.
Yep.
So
Yep.
we as an industry are about 25-30% of India's credit. So we are a large part of the financial ecosystem, of the credit ecosystem. And this kind of supervision is required, right? It obviously for the industry, there is a additional cost. But what this does is this really brings us at par with banks when it comes to supervision. I mean, when RBI comes to us as Hero FinCorp, last inspection they did was for a month-long inspection. And earlier we used to see week, 2 weeks, but they come in, they really inspect. And what I feel is that this is good for us. It's like a parent and child relationship, right? The parent is telling the child, do this, it's good for you, but the child says, no, this is not good for me. But actually, it is good for us because the parent doesn't want the child to fall, and the parent doesn't want the parent wants the child to succeed. So it's the same relationship between the regulator and the regulated entity, which is very good and healthy for the industry. It will separate the men from the boys, and it also brings in a lot of trust from different angles. One, from equity and debt capital markets within India and outside of India. So now investors know that if you are an upper layer or a middle layer NBFC, you're well regulated. You're not a shadow bank. We trust this industry. So it is not doing stuff which we don't want them to do. And a lot of capital has been attracted and will be attracted just because of this. Whenever I go and speak to investors, they obviously are worried about compliance, but they are worried in terms of, has the cost of compliance increased? I said, yes, it has, but that's the cost of doing business. But they also get more comfort and they say, okay, we want to double down on this industry. Also, there is a conscious effort where RBI itself, the regulator itself, the parent itself, now has started trusting the child because they know that this is a big industry and this is something which is driving financial inclusion. And they are aware that for this GDP of doubling the GDP till 2030, NBFCs are going to play an important role. And hence, there is that trust building exercise that is happening. And like you would see in mutual funds, AMFI has come out with a lot of campaigns on how good mutual funds are. RBI has come out with campaigns, RBI Kehta Hai. So they are bringing awareness with the end consumer that we regulate NBFCs and we are there as a counselor or we are there as an ombudsman for any complaints. So that is the other channel which has started. So I think trust is a very important part for this industry, and not only between NBFC and regulator, but I think the supervision attracts a more robust trust between investors and the NBFCs and the end customer in NBFCs. So overall, there is a big focus which we welcome, and we want to be shown in good lights. We moved away from shadow banks to non-banks, and I think we should also in future remove the non-N of the non, because that has a negative connotation. So really be a finance company rather than a non-bank finance company to get away with any of the perceptions. So that is our aspiration, that next few years we should be called finance companies and not a non-company.
I love that last sentence, huh? I think there's something about taking away that to make it, we used to have a period long ago, just a small parallel, when we used to have Japan business was used to be separate, and the rest of the business was called Asia non-Japan, ANJ. And,
Correct.
that used to feel so funny. And then it was brought together and it's all Asia, so I think I fully resonate with that. I have two emotions as I reflect on this. One, thank you for providing a candid view of what you're seeing happening on the ground and a very reflective view. And the second is, I do walk away with a lot of optimism from this conversation. Optimism about what it could mean for consumers, optimism about the future in terms of where technology is taking us, but most importantly, on the foundation of trust that is underpinning all of this. So thank you, Abhimanyu. Thanks for your time and great talking to you.
Thanks. Thank you, Neeraj. Thanks for the time, and it was likewise, it was good to talk to you. Thank you.